It's about time we talk about inflation. I haven't talked about inflation in a while now, and now we're seeing that inflation has gone from 8 to 9% on an annual basis to around 5 to 6%. It's hovering around that range. Now, just to clarify, we are getting these numbers, these statistics from the BLS. So this is the Bureau of Labor Statistics. This is coming from the federal government. Now, the federal government, just to paint a picture for everyone, yes, they want to look good. They want to put out numbers, and they want to create a type of situation where the average consumer is looking at our monetary policy, at least from a layman point of view, and they're seeing that their money is okay. They're seeing that, yes, prices are going up, but it looks like what the federal government is telling me, what the figures of authority is telling me, because they're taking their information and they're pouring it onto the media apparatus. So now the media, you have the federal government, all these trusted institutions, at least what I've been told, I'm saying this from an average person, what I've been told are trusted institutions. They're saying that the inflation number is coming down and things are normalizing. So that is what the average person is saying. That's what the federal government wants to portray to the people, because the federal government understands that they can't create panic, they can't create havoc. They need to make sure that there's order in society in terms of the monetary policy, even if the monetary policy is not sound. Now, to pull back the curtains and dive deeper into this, the average person is not aware of how the CPI even works. So just to go into that a little bit, the CPI number that'll come out typically on a monthly basis, and based off of the CPI number, you'll have the Federal Reserve determine if they're going to increase, decrease, or just stay the same in regards of interest rates. When you increase the interest rates, you are making it harder for capital to be borrowed. So you're increasing the amount of interest on money that you're going to borrow. So therefore, businesses, institutions, they're not going to borrow as much money. There's going to be less money in circulation. That's the goal of increasing interest rates, so that you're pulling the money out of circulation. When you do the opposite, when you decrease interest rates, you make money cheaper. So borrowing money becomes a lot cheaper. Now, that would again, in theory, the reverse of what I said before, that would produce more funding for businesses, for investments, all those kind of vehicles. When you keep it the same, you're just plateauing, you're maintaining the current system, you're maintaining the current status quo. Now, the number will come out with CPI, and although it looks like the CPI is coming down, what people are not looking into is how the CPI is being rated. So typically you would have a good or service, so like let's say beef, let's say 70% lean beef, and you would take this beef and you would compare it to the next month or the next year, and you would see what the prices are. And based off the price, you would calculate the difference. That's the inflation rate. What the federal government is doing, the BLS is doing, is they're taking the 70% lean beef, and they're changing it with another good. So they're substituting it. Then they're going to put in like 90% lean beef, and they're going to say it's a substitute, but oh, look, the price didn't change that much, therefore the inflation is actually 0.3% instead of 4% for that good. Then they take a few goods and services and they average it out, and that's how you get the inflation number. So they're substituting goods and services when they shouldn't be, because they want to manipulate the CPI. They're also determining different ways of looking at the CPI. Oh, now we're creating a different segment or different category. This is the core CPI. This is what actually matters. And that happens to be lower than the actual CPI that we've historically been using. So now this CPI is portrayed to the mass media. The mass media distributes it to the average person. The average person thinks CPI is okay. So there are a lot of tricks and tactics that are going on. If people want to look at their actual goods and services, depending on the good and service, it's not every good or service, but depending on the good and service, depending on the industry, you might see a 20 or 30% increase in a good or service price, and therefore the inflation in relative terms to you is actually 20-30%. If you average it out for your expenses, right? So the 5 to 6% that the federal government is saying to you may not even be relevant to you, because the lifestyle that you're living, it may not, I'm not saying a crazy lifestyle, but just what you're doing on a daily, weekly, monthly basis, those expenses are 20-30% more. So people have cognitive dissonance in the sense of, they see that the prices are going up in their daily, weekly, monthly expenses, or maybe they don't, because a lot of people don't even look at their financials like that. They don't have a budget for themselves. But let's say they are or aren't aware, and then they get the number from the federal government, and that number is different than what they're doing and what their friends are doing, how much they're spending, what the difference in spending is for them. And that's that dissonance, because they don't see that hey, hold on, the numbers don't add up here. I know it's anecdotal, but if I'm collecting data for myself and 5 other friends, this is very different than what the federal government is telling me. So now this goes into inflationary terms. Now, inflation will come down. I'll explain this. As the Federal Reserve tightens, so there's going to be if I could create a visual chart here, it would be the Federal Reserve. There's too much money in circulation. They have to bring some money out because this is going to inflate the dollar too much. Now, the people at the top, the people who are multimillionaires, multi-billionaires, the politicians, the elites, the celebrities, all these people who are, let's say, at the top of the hierarchy, just in terms of wealth, these people can afford a 10, even 20% inflationary rate. The average person cannot. The average person barely has any disposable income. I mean, really, the average person does not have disposable income because they're living paycheck to paycheck. The majority of people, they don't even have enough money for an emergency, like a $500 emergency. So the people at the top, they can afford that high inflation number. But once it gets to 30, 40%, that's when they start panicking because now it's taking a huge chunk of their money. So just let's say we're using the W-2 earned income tax rate. You go to the highest bracket, it's about 40%. I think it's like 39.4% or something like that. It's about 40%. If you're making millions of dollars and you get a 40% tax on your money, you still have plenty of money to play with. Once that tax becomes 70 or 80%, that's when you start to panic. So that threshold is, even though it may be higher in proportion compared to the average taxpayer, because the average taxpayer is paying like what, 15 to 25%, even though you're at 40%, you can still withstand a lot more than the average taxpayer because you have a lot more disposable income to play with. Once that threshold gets broken, 70, 80%, that's when you start to panic. So the analogy is to the inflation number. Once the top of the hierarchy in terms of wealth experiences 30 to 40% inflation, that's when they start panicking. So the people at the top, the people who are controlling monetary policy, they don't necessarily want the dollar to be inflated to 30 to 40%. Now, by the time that actually happens, it may be too late for them to do anything. A lot of currencies have collapsed in many other nations like Venezuela, Zimbabwe. So by the time that happens, it may be too late. I'm not saying that's going to happen. I'm just painting a perspective. Now, what would typically happen? What is most probable to happen is we are seeing the BRICS nations, so Brazil, Russia, India, China, South Africa, they're coming together, forming their own coalition. And I've talked about this before, but they're trying to create their own world reserve currency that most likely will be the yuan because the yuan has, it's tied to China. China has a lot of leverage right now in terms of trading and exports, imports. And so they want to do business like with the Middle East, Saudi Arabia, and oil. They don't want to transact in dollars anymore, which historically the United States had given protection to Saudi Arabia to transact in dollars for oil. And therefore, everyone who transacts with Saudi Arabia for oil is going to have to transact in dollars. Now, Saudi Arabia no longer needs that protection as much. So they're looking at China. And the reason why the catalyst was if Russia had all this money in treasuries or just U.S. currency and different assets, different vehicles of investment, if the U.S. can freeze their money, well, now the U.S. dollar is no longer this currency that can be safeguarded. It can be, in a moment's notice, taken away from you. And so that kind of embraced fear in a lot of nations. And they wanted to form this, well, they've already had this coalition for a while now, but they came together finally because there were multiple catalysts leading up to this. And they said, well, hold on, the United States has way too much power. They're taking their dollars, and even in their bills, they're giving, $50 million to Pakistan to fund gender studies. The only reason why the United States does that, the Congress does that, is so that those $50 million are being spent somewhere and someone is using those dollars. And therefore, when you have your currency in the global trade, you actually make that demand for the dollar stronger. It's such a weird phenomenon, but that's how they do things. So you have other nations who want to be on top, and they see the threat of the United States of America. They've always seen the United States as a threat, but now they're saying certain catalysts as, well, we don't even want to have our money in dollars because we don't know what the U.S. could do. They have too much power at this point. If we form our own world reserve currency, we can use our currency, and we're all on the same side. We're all on the same team, and we trust each other a little bit more than we trust the United States, essentially. Now, what this would do is when you change the world reserve currency, it doesn't happen overnight. Like the British pound was the world reserve currency before this. There's a transition period. It takes a few decades, a few generations. And the standard of living goes down. That's really what happens, right? Because if you look at England, they still have the British pound, but it's no longer the world reserve currency. So it's not as strong as the US dollar. It's still strong, but not as strong. that means that overall you cannot export the pound all over the world compared to what you can do with the US dollar. Now, the US dollar is not being used like 80-90% all over the world. I mean, it's used all over the world, but that number has gone down in percentage terms. I believe it's around 40 to 50%. It used to be extremely high, 70-80%. So maybe only 20 to 30% in the future will use the US dollar as their standard of currency. Therefore, the demand of the dollar goes down. We can't export our inflation. So we here in the United States, the average American citizen, deals with slightly less inflation than other nations because we're able to take our own currency and export it to other nations. Therefore, when we print a bunch of money and we cause an inflationary action, we're actually exporting part of that inflation to other nations and spreading out that inflation. So it hurts us here domestically a little bit less. Versus if you inflate the ruble, like in Russia, you can't really export it anywhere. So everyone domestically is going to feel that inflation because it's just being circulated in your own domestic nation. This presents a problem. Let me go into the solution now because I've already presented the overall problem. What we as Americans can do, or just what the average person can do, even if you're just in the world because you still use the US dollar to some extent, is first you need to make yourself indispensable. Not everyone can do this, and not many people. I mean, there's not millions of people watching this video, but make yourself indispensable wherever you're at right now. So if you're working 9 to 5, make yourself indispensable. Make yourself reliable, trusted, sharpen your skills, make it so that it's hard to replace you. Then what you need to do is you need to go out and also look for better opportunities. It's going to be very hard to do that in this recessionary environment, even though the White House is not classifying us as in a recession. Conventionally, it's been 2 negative quarters of a GDP, but the White House is changing the term just so it fits their narrative. But we're in a recessionary period of time. It may not be opportune to go out and find another job, but have your options open. And I'll say the main thing is start something on the side. It could be flipping shoes. It could be something simple. It could be starting an actual small business. Do something on the side, a side hustle that you could turn into a full-time business, or maybe you just want to keep it as a part-time business, but something that can generate revenue. It may not start money immediately for you. It may not collect a bunch of revenue immediately, but over the long term, it could potentially. So don't do something that's pie in the sky. I mean, you could do that as a hobby and build up to that, but do something that you have interest in, you're good at, and you can monetize. If you can combine all 3 of those things, you can have something that's sustainable. This is mainly to diversify, to ensure that you have more than just one income source. Then what you want to do is you want to take your currency, your cash. Sure, you want to have your emergency fund, your savings, all that. And you can even tier and layer where you're putting your assets. So you can have multiple brokerage accounts, you can have multiple bank accounts. You can spread out your wealth just in case one brokerage kicks you out or they go bankrupt or whatever it is, right? And you need to put your money in productive assets. So a lot of assets are low right now just because we're in a recessionary period of time. The stock market has taken a huge hit. So if you find assets that are productive businesses, they have a productive business model. It doesn't have to be a stock, although it could be a stock. It could be a real life business. It could be a franchise. But if you're seeing a solid business model, they're producing cash flow, they have some cash on hand, their debt is low, you like the management, you need to start investing in those businesses. Again, it can be stocks, it could be in real life. You actually know the business owners, you actually can see it tangibly, or it could just be, I don't want to say specific companies, but a company that is trusted, you've done your due diligence on the stock market. Think of it as you're buying a piece of the business, you're not just pushing money in and out, right? It can be very liquid, but you're treating it as a business. Like you own a piece of the business, you own you're a shareholder as part of the business. Then you need to, of course, look into conventional means, which is metals and things of that nature. This now becomes not ways to grow your wealth, but ways to preserve your wealth. Then you have speculative assets. So this is like crypto, Bitcoin. That would be speculative in terms of it's not productive. It's not producing anything for you. It's more of a hedge. Or like buying a really nice supercar, you know it's going to maintain your value. There is a cost to maintaining the supercar even if you don't drive it. But let's say you know it's going to maintain its value or grow in value. People also buy watches. Now, I'm not advocating for all that just yet. All I'm advocating for primarily, is you make yourself indispensable. You find other opportunities. You leverage your skills. You start a side hustle. You build businesses on the side. You collaborate with other people. You build a network. You take your money and you put it into productive assets, productive business models. And then if you have extra money left over, then you can put it into places that store value, places that will hold value. And that could be some productive, some speculative, right? And it should be a small percentage of your portfolio, not a huge percentage. But if you're diversifying to an extent, you'll be all right. You'll preserve your wealth. Now, obviously, this is reverse to when you're trying to grow your wealth. You have to concentrate a bit if you're trying to grow your wealth, right? So you maybe only put a huge chunk of your money into one person may put all their money into one business and just concentrate fully on that business. Another person, like Warren Buffett, may put all of his money spread across 3 stocks and grow with those stocks. And you can also run, by the way, on stocks, you can run conservative covered calls with those stocks and therefore produce weekly and also monthly income using those stocks. So you would have the asset appreciate over time, and then covered calls would be your capital gains, short-term capital gains. And then you got to make sure you do your taxes and all that. So the point of this is inflation is coming. Inflation is already here. Hyperinflation is a possibility. We're losing the world reserve currency, and therefore we can't export our inflation everywhere else. So inflation is going to hit us harder. That will happen gradually over time. I'm not saying it's going to happen tomorrow. But when you understand this, you can take some actions, some precautionary actions to beef yourself up, right? I understand not everyone is in a situation in their life right now where they're financially stable. But all that financial freedom means is that you have stability in your life to do what you want to do. You're not dependent on someone or something. Now, to an extent, we're all dependent, right? So even if you're financially free and you have 5 or 6 income sources, you're still dependent on those certain platforms that you're getting revenue from. Or if you have an audience, you're dependent on the audience, right? But you're less dependent on just one concentrated source that can be cut off from you. That's the most vital and most tangible aspect that you could get out of this.